everyone, so I just wanted to do a recap video for 40A Halton District Centre, which is the vanilla buy-to-let property that we've just completed on. To really run through a little bit about kind of the options that we had available on this particular deal, a little bit more about the figures, and also a little bit of kind of story in terms of how the sale progressed, a couple of challenges that we came up along the way, and obviously hopefully a bit of a success story at the end in terms of how it's kind of all ended up. So with this particular deal, obviously you've seen the breakdown that we gave you in the kind of the initial videos, but with this particular deal we had two options. We could have either sold it as a finder's fee, so just as a sourcing property, and we could have sold on as one individual deal, or potentially do a joint venture. Now, from a personal point of view, I prefer doing joint ventures on certain deals or on most deals if we can, because there's more of an upside for us on those types of deals. You can certainly earn good money as a sourcing, and it helps to earn kind of decent cash flow when you're doing a lot of deals. But if you're looking to grow relationships, if you're looking to grow partnerships with joint ventures, then it's great to bring these types of deals to the table and do something together as well, and kind of spread the wealth and the benefits, if it were, on these individual deals. Now, on this particular property, if we'd gone down the sourcing route, we certainly would have got a good return on the amount of time that I spent on the deal, and also would have got a quicker turnaround for the fee. So time frame was about 2 months in terms of from initially going around to spotting the property, when we did the initial kind of look, if it were, of deals in that area, through all the way through to kind of completion. But the downside to selling it as a sourcing deal is your fee is going to be limited, because it depends on what areas you're working on, the value of the properties. But this particular property was, as I showed you in the early video, on the market for about 50,000. So because of the value of the deal, and because of the discount that we actually could have achieved on this particular property, we wouldn't have been able to charge too high a sourcing fee, because the benefit is really in the rental return, and too high a fee would have severely reduced that potential rental return. So we would have had to, I suppose, limit what we could have charged. So typically for the sourcing fees we charge around 3,000 a property. Now, if we charged that on this particular deal, it probably would have been perceived as quite high. The likely sourcing fee would have been about 2,000, and if for whatever reason we'd maybe found the property but we're struggling to find a buyer because of the location, obviously not necessarily the rental yield, but the amount of discount or something on the deal, then a quick sourcing fee to get it sold might have been kind of 1,000. Now, I don't try and drop or change the sourcing fees that we charge too much. I try and keep it consistently at 3,000 a property. There's a whole host of reasons for that, but mainly because the amount of effort it takes in each individual deal is relatively similar. You might have some deals that take a little bit more time or need a little bit more involvement, but typically the amount of work is the same. So whether you're working on a £50,000 property or a £250,000 or £500,000 property, you're probably going to be doing a similar amount of work in terms of the negotiations, in terms of the sales chasing, and in terms of the feedback between obviously the buyers and sellers and that type of thing. So there's going to be a certain level of work involved in that, and you want to kind of maintain some consistency with the fees. But obviously you have to strike a balance with that. If you're working with lower value properties, it can be hard to charge sourcing fees around too high a level or too high a perceived level, if it's going to affect the deal somewhat in terms of the level of discount and rental that's going to kind of achieve. But let's give you some kind of estimated figures really. The other option was if we'd gone down the joint venture route. And also as a sourcing fee, just quickly on this one, that when you're buying properties via an estate agent, and especially with these types of deals where you have speed is going to be part of the benefit of what you can bring to the table and why you might get the deal agreed, you do really have to have a reliable cash investor ready to kind of go. If you're not buying the property yourself, if you're selling it as a sourcing deal, then you need to have that buyer ready to kind of go that you can kind of trust and rely on, because you need to prove that you're able to complete on the property quickly for the agent. So the certainty of sale are going to be critical in this case. So if we've gone down option 2 route, which is the route that we did take, which is to do a joint venture, we certainly get a higher return and profit potential on the deal than what we do with a sourcing fee, but there's going to be a longer payoff in terms of timeline. So the time frame is a little bit more open-ended really. It could be 6 months, 12 months, 2 years. It depends upon the investor that you're buying the particular property with. On this particular deal, there's no Potential to refurb it and then sell it on as a kind of flip deal because it was already in very good condition. The deal itself worked very well as a long-term vanilla buy-to-let, buy and hold, and it achieved a very good kind of rental yield. So that strategy on the deal makes sense. And doing it as a joint venture, we have to kind of keep an open-minded time frame with it. So we wouldn't typically do this as a joint venture with somebody we've never done any deals with before, and we'd like to do this as a deal with somebody that we're looking to continue to do work with on a regular basis, because we're going to be having that involvement together, with it being kind of an open-ended time frame really. So by bringing deals like this to the table with joint venture partners that you're already doing stuff with, it brings a lot of extra benefits because you can continue to keep providing those joint venture partners supplied with good deals, and you're able to do kind of more potential deals in the future because they can see the benefits and the payoffs for it. So there's a trade-off in terms of higher profit, but kind of a longer time frame in terms of when you might achieve and benefit from those profits, but it allows you to develop more deals with that joint venture partner. So on these figures, we've put down a yearly rental profit of about £1,200. So that's £100 a month, which we should comfortably achieve on this particular deal. As I showed you on the figures kind of before, it should rent out around £550 a month, and it should give us a kind of a very steady return. It's in a decent area in terms of rental. It'll probably be local housing allowance tenant profile, but it's a very good return for the value and the price of the property. Now with this particular deal as well, we'll have a profit on the resale because we're going to be splitting that with a joint venture partner. We've just put that in as estimated at 5,000 kind of plus now. So if we brought the property at 50,000, sold for let's say 65,000 in a year or two's time, and we've got a couple of £1,000 fees on that, then we're going to be splitting that 50-50. So we should have a profit of around kind of 5,000. Now it's also important that you make sure you have the correct joint venture agreement drawn up with a solicitor with any joint venture that you do, and particularly if you're going to be doing something that's over a long period of time. It needs to address those issues in terms of what happens if the property is vacant, what happens if a tenant doesn't pay the rent or damages the property. All of those things you need to kind of consider within that joint venture kind of partnership. So it's important you have the correct joint venture agreement drawn up whenever you're doing these sort of type of deals. So just to give you a bit of detail on the sales progress and a bit of a story and background in terms of how this deal kind of panned out. One thing I just kind of wanted to show you on this one, the profit on the resale we've put in about 5,000. As I mentioned there, if we purchased for say 50,000 and we sold for say 65,000 in a year or two's time. Now the figures on this deal look kind of a lot different than that now than what they did initially, and the reason for that is because during the sales process this particular property was very good condition internally, but it was a leasehold flat. So there's certain elements that you'll only find out about the property during the sales process. So when the solicitors start to make inquiries to the seller's solicitors and to the management company, then certain things will kind of come out of the woodwork and things that you might need to consider. Renegotiate sometimes, or just take on board some other times, depends upon what the situation is. But on this particular property we had some quite high maintenance costs that come out of the blue. So part of the inquiries that your solicitor will do on, let's say if you're buying a leasehold flat, would be to inquire as to any potential costs that might be coming up and any potential debt that might be owed on the current kind of flat in terms of the management charges and things like that. Now with this particular property they had a £15,500 maintenance bill due to come up in the next 3 years, and that was due to refurbishment for the roofs. It was due to refurbishment of the communal areas and a few other elements as well that were kind of built into that. But within the next 3 years potentially there would be a schedule of works that might need to be doing of around £15,500. That's quite significant on any property, let alone when you're only paying around, I think we got this one agreed initially at say £46,500. So that's quite a lot, or quite a chunk that needs to be kind of found. Now there's two ways in which we could have gone with that. We could have either got that renegotiated with the seller and had them take that on board, or we could have took that on board our costs kind of ourselves. Now it's important to note that at this stage you've not purchased the property, so anything like this is really the seller's issue. It's their problem. It's something that they need to kind of resolve before the deal can kind of progress. Now, some sellers won't be able to. Some sellers financially won't be able to take that kind of hit, and other times the seller might just expect you as a buyer to be taking kind of that on board. Now, with this particular property, we managed to renegotiate it with the agents and with the seller on the property. The whole price in terms of this 15,500 that might need doing on the property off the price. So we managed to get that 46,500 down to 31,000 in terms of a new purchase price agreed, which is phenomenal. It's great. It wasn't something I was expecting. Obviously, when the maintenance costs kind of came out of the blue for it, I was assuming that it was probably going to fall by the wayside as a deal. When we put the new offer to the seller and to the agent, and obviously explain the reasons why, and that any buyer is going to have a similar issue. It's not just something that kind of we're going to be affected by. It's, as I said, it's the seller's problem currently, and any potential buyer, whether they're cash or mortgage, are going to have a problem, and certainly no mortgage is going to lend on the property with that kind of hanging over it. So we went back to the seller, offered a reduced price at 31,000. The agent went back to the seller and discussed it with them. And then obviously their solicitors got wind of it, and their solicitors advised the seller not to accept because they thought we were trying to pull a fast one in terms of the kind of the price. Obviously the seller had kind of looked into it. They'd then spoken to the freehold company, the freehold management company, which is what we advised them to do in terms of as part of the renegotiation. We said, look, this isn't something that we're trying to be kind of tricky on the deal. It's something our solicitor has mentioned to us that the schedule of work is going to be needed. I'm more than happy, and I'd like the seller to confirm that as well with the leasehold company and with their solicitor, so they knew that we're not trying to be, as I said, tricky on the deal. Seller had a think over it overnight and came back and accepted it. So you do get these situations where sometimes the seller won't be able to accept it, as I mentioned. On this particular deal, the seller's reason for selling the property was because it was a probate deal. So they were going to sell the property anyway. They'd have this potential problem with any buyer. It's not just kind of ourselves. So that's the reasoning, I guess, behind them accepting it. But it is also the way you put forward. If you kind of go back to the seller or go back to the agent on this particular deal as an example and said, obviously this has come up, we're not going to pay anything more now than 31,000, leave it at that, put the phone down, it's not going to work, because you've got to take a more softly kind of softly approach with it. Really, you've got to explain the reasons for the change in offer. You've got to kind of frame it in a way that the estate agent can then put it to the seller and say, obviously, look, the current buyer has this potential problem, you'll have this problem with any other future buyer, and go through the normal kind of process, and then you obviously stand a much greater chance of getting this particular or getting that situation kind of agreed. So obviously a little bit of a potential spanner in the works earlier on when the maintenance kind of costs were flagged. It's important to stick to your guns. It's important to make sure you work out the figures, what you're happy with, what you're happy to pay. It was very likely that we would have lost the deal potentially anyway, because we would have had to knock this 15,500 off the price. If that didn't work for the seller, we would have had a couple of hundred invested in terms of legal fees, but it would still be worth walking away at that point, as opposed to taking on a deal that's going to have this massive maintenance cost coming up within the next kind of couple of years. So we had a chat about it. It was a property that we brought with a joint venture partner. We had a chat about it together and decided that it wouldn't work for us if we had to pay the full 15.5k. It wouldn't work for us even if we kind of contributed half, because it's still significant, and that price might be lower in 3 years time. It might not be that kind of level of work required, but the potential is there that it kind of could be. So we had to negotiate, we had to stick to our guns on it, and luckily it came through. So we managed to get that agreed for 31,000. So that's a 3-bedroom flat that we purchased in Little Hulton near Worsley in Manchester, or near Manchester, for 31,000. It's got a local housing allowance rate of £550 a month, which gives us a projected gross rental yield of 21%, and that's on a standard vanilla buy-to-let, which is fantastic. Obviously, as we've spoken throughout the training, our target typically is around 8% gross rental yield. This particular property on first sight when we found it on the market with an estate agent, so there's no cost in terms of finding the deal. It was on the market for anybody to go into the estate agency and buy. It was open and accessible to kind of the whole of the market. Gives us a fantastic rental yield, and we brought it not because of the potential discount, we brought it not because of the potential to add value with a refurbishment. It was just a solid long-term kind of vanilla buy-to-let that, even at the original price of 46,500, still gave us a very good rental yield. Obviously a little bit of progress happened during the sales process where we got the price reduced even more, so for those first couple of years until that maintenance kicks in, we're going to have a much higher rental yield. When that maintenance kicks in, obviously we'll have some cost to pay towards that, which is going to reduce the net yield or the gross yield as well, and obviously we've got a little bit more invested in the deal, but it's still going to be anywhere between kind of 31,000 and 46,500, which was our original offer. So still a very good kind of price really. So hopefully you can see on that kind of deal how the figures have broken down, and how it doesn't take a kind of slick marketing strategy to find all the deals. Sometimes just using very simple methods that we've kind of discussed and shown in the training about how to pick your area, how to spot potential deals, and then how to negotiate them with the estate agent, gives you a great chance of finding deals like this that give you a great rental return and that can work very well as a simple vanilla kind of buy-to-let strategy. So hopefully you've found that case study helpful. You've obviously seen the deal as it's kind of progressed, and if you've got any questions about kind of how this particular deal or on this particular deal, yeah, feel free to ask. Just put them in the comments below. I'll be more than happy to help.